In today's video, we're going to be breaking down the secret holy grail indicator that has allowed me to be profitable and so many of my members to level up their trading after implementing this secret indicator. And guys, this indicator is the one that banks don't want you to know about. All right, this is the thing that keeps them profitable and they don't want you to know about. All right, so I'm about to reveal it to you and share the secret, so don't tell anybody. Okay. All right, so sarcasm aside, this is not a secret indicator. It's just one simple indicator I use in my trading that has leveled up my trading. I've taught it to my mentorship students and my Discord students, and all of them have implemented it and completely changed their trading. It allows them to take trades in the direction of the trend, catch higher probability trades, not get faked out on fake trend reversals. So if you guys want to level up your trading and catch higher probability trend following setups, pay attention to this video. We're going to break it down right now. And we're also going to go over some setups on how I implement this and I use this in my own trading strategies. All right. So this secret indicator, again, there is no secret. There's no holy grail. This is just an indicator that I use. I'm just saying this as a joke. So if you guys are new here, I'm just joking around when I say this. All right. That's why you have these mixed caps right here. The indicator that has changed my trading for good and many of my students as well is the boom 200 EMA. 200 EMA. One of the best indicators I've ever implemented in my trading. This indicator allows me to, again, catch trades in the direction of the trend, make sure I'm catching high probability moves, and eliminates trading in the direction of in the market whenever we have a choppy environment. We don't want to be taking any trend following trades during a choppy environment. So if you trade a trend following strategy, the optimal market environment is another trending market. So with that being said, let's go into actually how I use the 200 EMA to catch my trend following trades and ensure I'm taking a trade in a high probability move. Okay. If you guys trade any sort of trend following strategy, you guys will significantly benefit from this because it allows you to catch plays in the direction of the trend majority of the time. Now, I know you guys see my charts a little bit messy. I have so many lines and so many boxes everywhere. This is the main chart that I use, the 30-second chart on the right. I also have the 1-minute chart on the left, and I have the 5-minute chart on the bottom left, okay? I barely use the 5-minute chart. That's just to quickly get a glance at what the bigger picture looks like. The 1-minute, pretty much the same thing. I don't take any entries on there. The 30-second is my bread and butter. Oh, boy. I could tell you everything about the 30-second. I take my trades every single day on the 30-second time frame. Here's an actual example of today's trade, which we'll possibly talk towards the end of the video after we break down the 200 EMA. But today's video is actually about how to use the 200 EMA. So I'm going to actually get rid of this indicator right here, and we're going to focus on this chart on the right. All right, I'm going to make this fully expanded. That'll make it a lot better. So how do you use the 200 EMA to catch high probability setups, Aro? Teach me, please. I got you. The way you're going to use the 200 EMA is simple. If price is below the 200 EMA, you're going to have a bearish bias. You're going to lean towards taking only trades that are bearish. If you're seeing price hover above the 200 EMA, simply put, you're going to have a bullish bias, meaning you're only going to look for taking trades to the upside. That's it. All right. That's the main way you're going to incorporate the 200 EMA. If we just briefly look at the chart, just using that criteria, when we're below the 200 EMA, majority of the time, for example, this huge portion of the time, we are downtrending really strong. As soon as we break above it, we're just barely starting an uptrend. If we are below it again, slightly downtrending. If we're above it, slightly uptrending. So, very good rule of thumb to play in the direction of the stronger high probability move. If we're below it, again, you see 200 EMA is this light blue line on the chart. We're below it, so we're going to have a bearish bias. And what do we see on the chart? A strong bearish downtrend. So if you guys don't know what the 200 EMA is, the 200 EMA is a simple moving average line that plots the averages of the past X amount of candles in the form of a line. And the X amount of candles is specified by a specific number. For example, I use the 200 because the number of candles, 200, represents a large enough amount of candles to be able to categorize the recent price action and put that into one value. So, for example, if I'm looking at, okay, at this current point, the 200 EMA is right here, all right? Right here. If I mark this going back 200 candles, it's going to grab the average values of all the 200 candles. Like, for example, let's say all these candles in this big circle, and it's going to plot the average right here at the latest point starting from the 200 candles going back from there, and so on and so forth for every new candle that's formed. So if a new candle that's formed, now it's the new most recent 200 candles. Another candle gets formed, it's the average of the new 200 candles again. All right, and it continues to do this, and after doing it so many times, you connect those dots together, and now you get a line. You get an entire line where all those individual dots are connected, and you could see the average moving as the candles are forming. That's why it's called moving average. Okay, you don't really need to know how it works, but that was a quick rundown if you guys are more technical, curious how it works and this, that. But that's generally how it works. Oops, I just deleted something I didn't mean to delete. All right. So the main thing you need to worry about is how you're going to implement this. If price is consistently holding below this average value, that shows the sellers have a lot of strength. That means price is consistently being lower than the averages, meaning sellers are stronger, because what do we need to see for the price to be constantly decreasing? We need a strength from the supply. We need a lot of supply and low demand. We have a lot of supply, which is a lot of sellers in the market. We're going to see price come down a lot. And when we see price dropping below the average price, that's a sign that sellers currently have strength. And when we switch, like over here, that's a sign that the strength has switched. Buyers and there's more demand in the market. Price is shifting up because price all just moves based off like supply and demand, but not off supply and demand zones. Supply and demand as if strength from buyers versus strength from sellers. All right. If there's more aggressive, strong buyers in the market compared to sellers, it's going to drive the price higher. And if there's more aggressive sellers versus buyers, then it's going to drive the price lower. Simple. Nothing overcomplicated. So the first way you're going to implement it is, again, price below the 200 EMA. You're going to look for a bearish bias. If it's above the 200 EMA, you're going to have a bullish bias. Now, the actual second final criteria you're going to also implement to make sure you're always taking high probability setups and you don't catch yourself trading at these very end turning points is by paying attention to the trend of the market. You're going to pay attention to what is the actual price action trend. Are we downtrending, forming lower highs and lower lows, or are we uptrending, forming higher highs and higher lows? If we're forming a downtrend where we're doing this kind of thing, that's going to fully solidify your bearish bias and ensure that you're trading in the direction of the strength while we're consistently maintaining that strength. The moment we switch our trend and start forming an uptrend like this, where you see buyer strength picking up, we're forming more higher highs and higher lows, that's a sign that we're potentially ready to switch our bias to an upside. We have two kind of conflicting signals. Even though we're below the 200 EMA, price is slowly starting to uptrend, and on the more recent time frame, buyers are starting to put in some more strength, and that doesn't make our bias too high probability. So you don't want to catch yourself trading in an environment where we're trending opposite to our bias. Okay, keep that in mind. You don't want to trade in an environment where the trend is opposite of the bias. You want the trend and the bias to be intact and in the same direction, or giving you the same signal, you could say, both giving us bearish. So for a bearish, strong bias, we're going to need a downtrend, and we're going to need price to be below the 200 EMA. Plain and simple. That's all you need to look out for. Once you have that, you can take your pullback setups, your trend following setups, catch retracements, continuation plays, whatever strategy you use. It's going to be really helpful to catch, a lot easier to catch trend following setups since now you're playing in the direction of the strength. And same goes for a bullish. Right? If price is above the 200 EMA, we want to wait for us to fully start uptrending, right? Higher highs and higher lows before we start to look for a bullish play. That'll also solidify our bullish play. In this case, you see we drop hella right here, a lot breaking below all these lows. So you don't really want to catch a trade in this environment or a continuation right here because, because we already dropped below all these lows. We had a lot of strength from the sellers on this down move. So catching a continuation play in this environment, also when we're really close to the 200 EMA, is not optimal. All right, that's why you only want to wait for strong, clear direction to take trades. And the way you can identify that, strong sloping 200 EMA and a strong trend. This was actually a trade that we took today with the Discord live, which we do every single day. If you guys want to watch your trade live, you can do so. Link in the description. We took this play using the 200 EMA bias that I use every single day for my with my strategy and with my actual alligator indicators. All right, I call it the alligator strategy. All it is using the Williams alligator with these specific settings. You guys can save this and apply this if you want, but using these settings, waiting for price to pull back between the green and red SMA, and then a continuation after we get a close back out of the green SMA, which is my entry confirmation. Enter a short position, stop loss at the furthest point of the pullback, and my TPs at the swing low. And we banked today. Beautiful. Beautiful setup. Literally saw almost no drawdown. First trade was actually a loss. This first one right here, about a 7 RR trade, which is insane. I don't usually like catching big RR trades, but you know what happens sometimes. 7 RR trade ended up being a loss, and then we caught a almost 4 RR trade on this W. All right, beautiful straight black BBCs to the downside. I like it like, okay, no, I don't like it. I like it on the chart like that, okay? All right, let's move forward. So that pretty much sums up how you guys are going to use the trade 200 EMA. That incorporating your strategies. I have one of my students who also incorporated their supply and demand strategy, another student who's implemented into their key level strategies, and some other students who are also using my previous momentum strategies with the 200 EMA. And it's making them a lot easier to find trend following plays because now they can visually see what is the actual bias of the market, what direction has strength, and they can clearly play in that direction. They don't have to confuse themselves and say, but like our trend is not as strong and we're a little bit choppy, but I'm not sure if we have a bearish bias. And they catch a trade and realistically it's not aligning with the 200 EMA and they take a loss and they're curious, oh my God, I keep losing, I keep getting faked out. But in reality, if you implement the 200 EMA, you're not going to catch every single trend following trade. You could get faked out, but the amount of times you get faked out relative to when you get faked out without using the 200 EMA is going to be a lot lower. So give it a shot. Try it out. Let me know if you guys have any specific questions about how to use it in the comments below. And again, if you want to watch me trade live and take the setups that I take every single day and join the community of like-minded traders and learn how to actually become successful with the right education, join up in the Discord in the link in my bio. Or, sorry, not bio, the link in the description. And I'll catch you guys in there, all right? Let me know. Drop a comment if you guys have any questions. We'll get to it as soon as possible. Peace.